here. As the markets react to the Fed's comments this week, our next guest warns not to expect a reversal of Fed hawkishness just yet. For more on this market action, let's bring in Charles Schwab, Senior Investment Research Manager, Kevin Gordon. Kevin, good to see you in person here. Just your take on what we have been seeing in the markets this week.
Well, I think it's a pretty clear, at least indication that we're probably moving away from inflation being the main concern for the market and stepping into, or at least bringing the labor market into the spotlight. Not saying inflation doesn't matter anymore, but I think, whether you want to look at the action, the reaction or lack thereof, I should say, relative to other CPI reports that we got on Tuesday, and then some of the comments from Powell on Wednesday, I think that we're probably, as we move into 23, at least inflation is going to start sharing the spotlight with the labor market. We still have a 7 handle on CPI, so it's not like it doesn't matter. But I think that given the emphasis now from Fed officials, most recently John Williams this morning from the New York Fed, on wage growth and how that's still one of the main causes that they see for inflation, I think we have to shift our focus to that, and investors have to too.
Within your notes as well, you talk about investors should be wishing for a recession sooner rather than later. What is the thesis behind that?
Well, I just think that if we're looking at it from the viewpoint of the Fed, and you want to see more economic ruptures, particularly in the labor market, I think to most everybody's surprise, the labor market's been relatively resilient this year and hasn't cracked maybe as much as certainly we would have expected. So you would almost wish for that sooner, because it would signal to the Fed that their policies are working, not feeding through just to inflation, but also to labor. And obviously their forecast is for no recession, but implicit in their forecast is a recession if you look at the unemployment rate, especially with the latest increase from their summary of economic projections. But our theme has been, if you see that weakness earlier, it probably sets the market up at least for better days later next year. I don't want to base it off of, we get to June and then everything's fine, but you would almost wish for that pull forward, because that's what they're going for. Effectively, a recession is a feature of what they're trying to do. It's not a bug.
Are people focused on the wrong recession, not the economic recession, but the earnings recession that might come next year? And how bad could that look?
I don't know if it's a focus on the wrong. I mean, I think it's, we're already in a form of recession. You want to view it as a rolling recession. It's happened in housing. It's happened in CEO confidence, consumer confidence, manufacturing sentiment. We think that the last legs to fall really are on the corporate earnings side and then ultimately the employment side. So I think we're right to shift focus to that. It's just going to happen in different pockets. The earnings recession is happening for goods-oriented companies and those that benefited most from inflation and that surge that we got. It hasn't happened yet for services-oriented companies. We think that'll probably, it'll start to shift into there, not anything catastrophic like you saw in 2008 or 2020. But it's probably going to start moving its way there if that's what ultimately the Fed wants to see.
Just a follow-up to what you were mentioning earlier. What's the risk if we don't see a recession sooner rather than later? What is that kind of longer drag effect that we have?
Well, it depends why. I mean, if it's because wage growth is sticky and it's taking longer for that to come down, you still have companies hoarding labor, then I think that risks a worse recession in the future. I mean, I think that would be worse for risk assets because, it would at least, if we get a little bit of a lift, if you see a little bit of a reprieve because there is a notion of a soft landing unfolding, that's probably good in the near term for at least the stock market and what we cover. But I think it ends up being worse in the long term, because that either means that the Fed has to keep the terminal rate at its elevated, or the Fed funds rate at its terminal rate for longer, and or maybe go a little bit higher if they're not satisfied where things are going. So I do think if you push the recession out further, it's probably worse, because I think that the labor market strength in a way is probably its biggest risk and its biggest weakness later on.
What moves should the average investor be making in this environment into year-end?
Well, year-end is I guess, 10 days, so it's always tough to do that a couple of weeks. But moving into next year, we're still sticking with high-quality earnings themes around profit margins, but specifically looking for pricing power now, because one of the themes that you had seen in 2021 into 22 was companies that benefited a lot from that inflation surge. Top line and EPS growth was great, but now you're starting to see more of a divergence. And the companies that can maintain that pricing power will probably continue to do well, especially because input costs are still high. You haven't seen a release of labor, so unit labor costs have taken longer to come down. So as long as you can find that right mix of companies, and it's across the cap spectrum, it's not just large cap, it's not just small cap, we really think that you can look across sectors, across cap, and across many factors and just find something that's high quality, specifically as it's relating to earnings.
And so further out then, if you were to just find someone's recession portfolio and what that encompasses, is it more defensive? Does that continue to hold staples? How should people be repositioning?
It's not necessarily, I actually think staples, utilities, some of the traditional defensive sectors we think about, a lot of those companies have weak earnings profiles because they were the ones that benefited from inflation and from that strong top line growth, but now they're not able to benefit that from that, even on the downside. So they're not able to be those standard recession plays that you see. So that's why we've taken much more of a factor-based approach, looking for things with strong earnings yields, strong cash on the balance sheet, able to withstand any pressure from the dollar, both to the upside and the downside. It's a narrow group now because you have so many of these forces working against you, but as long as you're able to take a factor-based approach, not just look at sectors, especially something like just staples or just tech, because within that you have so many divergences in performances throughout this past year as to what's been doing well, but what's also not been doing well. So you have a mix of growth and value factors that have been giving you different signals. So that's why if you just focus on the factor, you don't need to necessarily be worried about the sector.
Charles Schwab, Senior Investment Research Manager. Kevin Gordon, always a pleasure to get some of your insights. Happy holidays to you.
Happy holidays. Thanks.